Canadian homeowners, if you own property right now and you are not paying attention to this new CRA requirement in 2026, you could be facing penalties that many people never saw coming. And the scary part is most of the people at risk do not even know they are at risk. They think they are doing everything right. They paid their mortgage. They filed their taxes. They lived in their home. But there is one specific thing the CRA is now watching very closely, and thousands of Canadians are unknowingly on the wrong side of it. By the end of this video, you will know exactly what it is, whether it applies to you, and most importantly, how to make sure you are protected. So, do not click away, because this one could save you a lot of money. Let us start with a quick background so everyone is on the same page. The CRA stands for the Canada Revenue Agency. It is the federal government agency responsible for collecting taxes and making sure Canadians are following the tax rules. Most people know the CRA from filing their income tax return every spring, but the CRA does a lot more than just collect your T4 information. It monitors financial activity, real estate transactions, and property-related income across the country. And in 2026, property declaration has become one of its top priorities. The reason this is getting so much attention right now is because the Canadian real estate market has been under enormous pressure for years. Housing prices went up fast, rental income exploded in many cities, and the government noticed that a lot of money connected to property was not showing up properly on tax returns. So they responded. New rules, new reporting systems, and new automated tools are now in place. And the people most likely to be caught off guard are everyday homeowners, not just big investors. Seniors, retirees, landlords, new immigrants, and people who recently changed how they use their property are all in the spotlight right now. So, why is the CRA watching property so much more closely in 2026? Here is the honest answer. The government has invested in new technology. The CRA now has automated systems that can match data from multiple sources at the same time. It can cross-reference property sales records from land registries, rental income reported or not reported on tax returns, changes in property ownership, and even foreign property holdings. This is not a manual process anymore. A computer is doing a lot of this work automatically. And that computer does not forget. It does not miss a year. It does not give anyone the benefit of the doubt unless you have the documentation to back it up. But here is what most Canadians do not realize. The CRA is not just looking at whether you declared income from your property. It is also looking at whether you declared the property itself and how you used it. Those are two very different things. And mixing them up or simply not knowing the difference is exactly where people run into trouble. Let us talk about what types of property may need to be declared. This is important, and it is broader than most people think. If you own a rental property and you collect rent from it, that income must be reported on your tax return. That part most landlords know. But what about a property you own that sits empty for most of the year? That could also come with reporting obligations depending on the province and depending on new federal rules around vacant homes. What about a cottage or a secondary home that you use sometimes but also rent out occasionally on a platform like Airbnb? That needs to be reported too, and many people do not realize the rules apply even when it is only rented a few weeks, a year. And then there is foreign property. If you are a Canadian resident and you own property outside of Canada and its value is over a certain threshold, you are required to disclose that to the CRA. This is an area where new immigrants and people with family property overseas are sometimes caught off guard. They assume that because the property is not in Canada, it does not need to be reported here. That assumption is wrong, and it is one of the most common and costly mistakes being made right now. This is where things get tricky, and this next part is very important. The mistake most homeowners make is not necessarily lying or hiding something on purpose. It is assuming that something does not apply to them when it actually does. Let us use a simple example. Say you bought a second home a few years ago. Maybe it was a place for your parents to stay. Then your parents moved out and you started renting it to a young couple to help cover your costs. You reported some of that rental income, but not all of it because there were months when the place sat empty and you thought you only had to report the months it was actually rented. That kind of gap can trigger a review. The CRA wants a full picture, not a partial one. Or consider this. You are a senior who owned a rental property for 20 years. You decide to sell it. You assume the full gain is tax-free because you have heard about the Principal Residence Exemption. But here is what many people miss. The Principal Residence Exemption only applies to the home you actually lived in as your primary home. If that second property was a rental, it does not qualify. And if you did not properly report the sale, you could be looking at a significant capital gains tax bill plus interest and penalties. Let us talk about what the penalties actually look like, because this is real and it matters. The CRA has the authority to charge late filing penalties and interest on amounts you owe. For unreported income or improperly claimed exemptions, penalties can range from a percentage of the unpaid amount to much higher figures if the CRA determines there was gross negligence or repeated non-compliance. In some cases, people have received reassessment notices years after a property sale asking them to pay back taxes they thought they had already settled. The interest alone can add up to thousands of dollars over time. This is not meant to frighten you. It is meant to be honest with you because the best way to avoid this is to understand it before it happens. And something else worth mentioning, the CRA also has a voluntary disclosures program. If you realize you made an error in a past return, you can come forward before the CRA contacts you. And in many cases, penalties can be reduced or waived. But that option disappears the moment the CRA opens a review of your file. So timing matters. Who is most at risk right now? Based on the current CRA focus areas, 4 groups of people should be paying extra attention. Seniors and retirees who may have owned rental or investment property for many years and have not updated their records or filings to reflect changes in property use. Part-time landlords who rent out a basement suite or a secondary unit and may not be tracking income and expenses carefully throughout the year. New immigrants who may still hold property in their home country and are not aware of the foreign property disclosure rules that apply to Canadian residents, and people who recently changed how they use their property, for example, converting a home from personal use to rental use or vice versa, which can trigger a deemed disposition that needs to be reported. If you fall into any of these groups, this video is for you, not because something is already wrong, but because being informed right now is your best protection. So, how do you check if you are actually in compliance? Start by reviewing how your property is currently being used. Is it your primary residence? Is it a rental? Is it both? Is it vacant? Write that down clearly. Then, log into your CRA My Account online. If you have not set that up yet, it is worth doing. You can see your past filings, check whether your rental income has been properly reported, and review any correspondence the CRA may have already sent you that you may not have noticed. Next, go back and look at your last 3 to 5 years of tax returns. Did you report all rental income? Did you properly claim or not claim the Principal Residence Exemption when you sold a property? Did you file Form T-1135 if you held foreign property above the required threshold? These are the key areas to review. If something looks unclear or you are not sure whether you did it correctly, that is a sign to get professional advice sooner rather than later. Here are some simple steps to protect yourself going forward. First, keep records. Keep a simple folder, even a digital one, where you track rental income, expenses, and any changes to how you use your property throughout the year. Second, report everything. If you have any doubt about whether something needs to be declared, the safer answer is almost always to declare it and let a tax professional help you figure out the correct treatment. Third, file on time. Late filings automatically attract penalties and interest even if you do not owe anything. And fourth, get help if you need it. A licensed Canadian accountant or tax advisor who understands real estate rules can save you far more money than they cost. Here is something important I want you to hear. Most Canadian homeowners are doing just fine. The CRA is not trying to go after ordinary people who made small, honest mistakes. The system is focused on compliance, on making sure the rules are being followed consistently. If you are watching this video right now, you are already ahead of the curve. The people who get into serious trouble are usually the ones who ignored the rules for years or assumed the rules did not apply to them. You are not doing that. You are paying attention, and that matters. Being informed is truly your best protection here. The rules exist. They are getting stricter, but they are also knowable, and now you know them. Which province are you watching from today? Let me know in the comments below. I always find it interesting how these kinds of changes can affect people differently depending on where they live in Canada. Your comment also helps other viewers see what's happening across the country and builds a more informed community here. Sometimes rules, timelines, and even payment experiences can vary by region. So, your input really does matter more than you might think. And if this video helped clear up something you were unsure about, take a quick second to hit the like button. It genuinely helps this channel reach more Canadians who may be confused or worried about these updates. For simple, straight-to-the-point coverage on CRA changes, CPP and OAS payments, real estate rules, and immigration-related financial updates. Make sure you subscribe so you don't miss any important alerts in the coming weeks. Before we close, here is an important clarification. The information shared in this video is provided strictly for general awareness and educational purposes. Canadian tax laws, including rules related to property reporting and CRA compliance, are subject to change at any time based on new legislation, policy updates, or administrative adjustments. In addition, every individual's financial and property situation is unique. Factors such as residency status, ownership structure, rental use, principal residence designation, and reporting history can all affect how the rules apply to you. For that reason, it is essential that you confirm your personal circumstances directly with the Canada Revenue Agency, CRA, or speak with a licensed Canadian tax professional before taking any action. Nothing discussed in this video should be interpreted as personalized tax, legal, or financial advice. Its purpose is to inform you so you can ask informed questions and avoid costly misunderstandings. The positive takeaway is this: you are now better equipped. You understand what potential red flags the CRA may be reviewing, which property situations could trigger reporting requirements, and what practical steps you can take to protect yourself. Awareness is your first line of defense. A simple review of your property records, ownership details, and recent tax filings can give you clarity and peace of mind. Taking proactive steps now rather than reacting to a notice later can save you time, stress, and potentially thousands of dollars in penalties. Set aside a few minutes this week to double-check your documentation and ensure everything aligns with current reporting requirements. Small actions today can prevent major problems tomorrow. In our next video, we will shift focus to an update that directly affects many Canadian seniors and retirees. There have been recent changes connected to CPP and OAS that could impact how much you actually receive in your payments. These updates are not widely understood yet, but they could influence your monthly income planning in 2026 and beyond. If you rely on CPP or OAS or plan to in the near future, this is information you need to understand clearly. Make sure you stay tuned so you do not miss details that could affect your retirement income.